Many people believe that generating income from the stock market is a complicated affair, filled with confusing jargon and risky maneuvers. However, one of the most straightforward and predictable methods is through dividend income. This approach is not about getting rich quickly or timing the market perfectly. Instead, it is about participating in the success of established companies in a simple, steady way. The core idea is that as a part owner of a business, you are entitled to a small piece of its profits. This concept is far less intimidating than it might initially sound, offering a calm and methodical way to build an income stream over time. The beauty of dividend investing lies in its predictability. Unlike the daily price swings of the market, which can be a source of anxiety for many, dividend payments often follow a regular and reliable schedule. This consistency allows investors to plan and anticipate their income with a degree of certainty that is rare in other forms of investing. So, what exactly is a dividend? In the simplest terms, a dividend is a cash payment that a company makes to its shareholders. When you buy a share of a company's stock, you become a part owner of that business. If the company is profitable, its leadership might decide to distribute a portion of those profits back to its owners. This distribution is the dividend. It is the company's way of sharing its financial success directly with you, the shareholder. You are not required to sell your shares to receive this payment. It is a reward for simply holding on to your ownership stake in the business. These payments are typically made on a consistent schedule, which adds to their appeal for income-focused investors. The most common frequency for dividend payments in the United States is quarterly, meaning you would receive a payment 4 times per year. Some companies and investment funds choose to pay dividends monthly. Others might pay semi-annually, or even annually. The company's board of directors determines both the amount of the dividend and the schedule on which it will be paid. For many well-established companies, these payments have become a long-standing tradition, maintained for decades. One of the most convenient aspects of receiving dividends is that the entire process is automated. You do not need to fill out any forms. You do not need to make any phone calls. You do not need to send any requests to the company. When a company you own declares a dividend, the payment is handled seamlessly behind the scenes by your brokerage firm or bank. On the designated payment date, the cash is simply deposited directly into your investment account. This hands-off nature makes it an incredibly passive form of income, requiring no active management once the initial investment is made. When the dividend payment arrives, it will appear in your account history just like any other transaction. For example, a deposit or a withdrawal. You will typically see a line item that shows the name of the company or fund, the date of the payment, and the exact cash amount you received. This transparent record-keeping makes it easy to track your income over time. To make the concept of dividend income more concrete, let's walk through a clear and simple numerical example. Imagine you have decided to invest $1,000 into a stock or a fund that pays dividends. Let's also assume that this particular investment has an annual dividend yield of 4%. The yield is a key metric that tells you the percentage of your investment that you can expect to receive back in the form of dividends over 1 year. Calculating your annual income from this investment is a straightforward matter of basic multiplication. In this scenario, a 4% yield on a $1,000 investment means you would receive $40 in dividend income over the course of an entire year. The calculation is simple. $1,000 multiplied by 4%, or 0.04, equals $40. This $40 is the total cash payment you would collect from this investment over a 12-month period, assuming the dividend yield remains constant. This figure provides a clear baseline for what to expect from your capital. Now, let's break that annual income down into a smaller, more frequent amount. While you would earn $40 over the year, companies rarely pay dividends in a single lump sum. As we discussed, payments are often made quarterly or monthly. So, $40 divided by 12 months equals approximately $3.33 per month. If the company in our example paid its dividend quarterly, you would divide the $40 annual income by 4 quarters, resulting in a payment of $10 every 3 months. Whether you receive $10 each quarter or about $3.33 each month, the end result is $40 over the year. At first glance, the income from our example, $40 a year, or about $3.33 a month, might seem quite small. It is certainly not an amount that will change your life overnight. This is perhaps the most important lesson in dividend investing. It is not a get-rich-quick scheme. The real power of this strategy is unlocked not in days or months, but over the course of many years. The magic ingredient is consistency, your own saving habits. company's ability to continue paying out profits. Small, seemingly insignificant amounts have a remarkable ability to grow into substantial sums when given enough time. One of the most effective ways to accelerate this growth is by reinvesting your dividends. Most brokerages offer a dividend reinvestment plan, DRIP. Enroll in a DRIP, and instead of receiving the dividend as cash, your broker automatically uses that money to buy more shares of the same stock or fund. In our example, the $10 quarterly dividend buys $10 worth of additional shares. That might be a fraction of a share, but it's a crucial addition to your holding. Reinvesting creates a powerful compounding effect. New shares bought with dividends also earn dividends next cycle. Your next dividend will be slightly larger, and that buys even more shares. This is the foundation of dividend income: simple, steady cash paid to investors for owning shares. At Dividend Anchor, this channel focuses on explaining long-term investing clearly, without hype or shortcuts. In the next video, we'll explore how reinvesting dividends leads to compounding, and why that's where long-term growth begins.